Welcome everyone to TMC Connect. We're going to let everybody come on in and then we will get started. Thank you so much for being here. Okay, we have still got some folks coming in, so I'm going to kind of go over a few of the ground rules before we get started on the presentation today. Today we have got John Holste and Rich Martin with us from Kyranos, and they have got a very interactive presentation for you. Got lots of poll questions, so be sure to have those answers ready. And we're going to be going over effective margin management. Check your pricing competitiveness. But before we get started, I want to let you know that everybody has come in on a mute. So if you want to ask a question, we certainly do want those questions and we want you to be engaged in the presentation. So please feel free to use the chat or the Q&A function to ask those questions. And then we will be asking those as we go along. Isn't that right, guys? We're going to just, if we get a question, we're going to answer those just as we flow through the conversation. So thank you in advance for all of those questions and for your activity during the polling. Once again, this is TMC Connect. I'm Tony Bramley. I'm the Director of Business Development here at TMC, and we very much appreciate your time today. So without further ado, I am going to turn it over to John and to Rich and let them get started.
Thanks, Tony. You hear me okay?
I can.
Okay, great. As Tony indicated, I just thought I'd give a brief introduction of myself. So John Holste, I've been with Kyranos now, going on 5 or 6 months. I was previously with a top 5 national bank and mortgage lender for about 20 years, in which I, during that stint, ran pricing and margin management for about 6 years, in which we highly leveraged the Kyranos solution. And with that, let me have Rich give a brief introduction of himself before we get into the meat of the presentation here.
Yeah, sure. Thanks, John. Thanks, Tony and Amy and the rest of the TMC family for having us today. Yeah, much like John, my background, I've been with Kyranos a little bit longer than John, coming up on about 20 months or so, but historically in kind of the revenue management, cap markets disciplined. I didn't have the Wells tenure like John and most people at Wells Fargo had, so I had a few stopovers. I'm based in the Seattle area, so a couple regional banks as well as some small and large independents. So I've leveraged the solutions extensively over the past 15 years or so at kind of each of those different stopovers in my career. So excited to talk about the topic today that we certainly hope is relevant to all, especially as we get into this year of transition in 2022.
Agreed. Thanks, Rich. And as Tony indicated, Rich and I really want this to be free flowing. So if you have questions throughout the presentation, pop them in the chat and Tony will do her best to weave those in. So to start us off here, I'd like to get the audience engaged a little bit. And the question is, what was Kyranos formerly known as? Tony will open up a poll. You'll be able to vote quickly here. We'll give it about 5 or 10 seconds. Rich will maybe sing a little for us.
It's not a trick question. We should probably clarify it. It's not meant to be a trick question.
Okay, so we have many different answers here. So we have 15 out of the 27 folks that are on the line with us today. 5 of them said Icon. 2 of them said FBX Informa. 2 of them said Navanas, and 6 said all of the above.
Good. So the answer is all the above. So we have a bit of a mixed bag there, which Rich and I figured would be the case. Kyranos, and it took me a couple months to figure out how to say that. We'll have a quiz at the end of the presentation here. But in all seriousness, Kyranos is a combination of the 3 companies mentioned. Icon Analytics, which I think many of you on the call are probably familiar with. That's what I used back in the day, I'll say, when I was in the revenue and margin chair. Icon Analytics is really the foundation of our mortgage solutions here at Kyranos, still here today. albeit those solutions have been enhanced as technology has advanced over that time frame. Icon was acquired by Informa FBX, I want to say about 2 or 3 years ago. And then most recently, we merged with Novantas. Novantas does a lot of the same stuff that we do on the mortgage side relative to competitive pricing and benchmarking, but on the banking side of the house, mainly focused in the deposit area as an example, so price elasticity. So we're all under the Kyranos brand now. That brand launched about 6 months ago. And if we focus on the mortgage side, which is obviously the focal point of the discussion here today, our 2 key solutions really support the margin management decisioning process for mortgage. We also have similar solutions for home equity and unsecured, but we'll stay focused on mortgage here today. Those 2 key solutions are outlined here on the page. Number 1, we have real-time loan origination performance benchmarking. This data set, I'll say, is extremely unique. Really nothing else like it in the industry. Covers about 60% of the mortgage retail market. And the key here is it's timely, which is really, really important from a pricing and revenue management share in terms of attempting to manage the volume margin trade-off as effectively as possible. Separate from that, we also have a solution focused on competitive pricing. And that solution really encompasses us working with hundreds of lenders in which we receive rate sheets from them. So it's lender sourced. And what gives us the ability to do is provide additional analytics and insights to our client base because it just isn't a snapshot. You can essentially create competitive pricing views over time and do a lot of deep dive analysis relative to various pricing scenarios, whether that be by geo, loan size, product, etc. And we really cover the mortgage universe from IMBs to credit unions and national banks and regional banks. So that's just a brief overview of Kyranos. Here's a couple high-level stats some of you may be familiar with. So a lot of experience. Rich and I, both ex-practitioners, along with a number of our colleagues. Icon Analytics, as mentioned on the previous page, that was started back in the 90s. So roughly 30 years of experience, give or take. All kinds of mortgage products tracked. We work with 41 of the top 50 lenders. Relative to that competitive pricing, again, since it's all lender source, that really gives us the ability to run through various, I'll say, loan level scenarios, pricing scenarios, or rep lines. Much of our business comes from repeat clients, and then we work with all of the top 15 lenders that are also financial institutions. So let's transition now into the meat of the presentation. We have a couple poll questions out of the gate here. We'll get into some common challenges that I suspect many of you can relate to as you think about managing pricing and margins. And as I think we all know, that environment has changed here over the past 3 to 4 months versus what was occurring in the previous 2 years. And then Rich will take it away in terms of how to maybe think about a margin management framework and the benefits thereof of managing that framework and actively managing margins. So if we move to the next slide, here we go. So fun facts, poll question number 2. How much of conforming 30-year agency 30-year fixed rates increased over the past month? 25 basis points in rate, 35 or 45? Looks like Tony, you already have the poll question out there.
Yes, we do. Overwhelmingly, we had 77% say that it was 45%.
No doubt rates have increased, and you all clearly indicated that in the poll here. The answer that we're seeing in our data is close to that 45 basis points in rate, 35 basis points. We can see this here, those rate moves here on the chart. This data is directly from that origination benchmarking platform that we have here in-house that covers about 60% of the market. We have 3 products outlined here. You can see your agency 30-year in orange moving from just above 3% to almost 3.5%. So 35, 40-ish basis points in rate in a month, which is quite a move. We've seen some pretty substantial market moves here throughout January with the 10-year almost touching 2%. If we go to the next poll question here, how much has rate term refinance volume dropped over the past month as a result of that rate increase? 15% all the way to 40%.
We've got answers coming in right now. Give everybody just another couple seconds to get their answers in.
Sure.
Okay, I'm going to share that out. We have 7% at 15, 27% at 25, 40% at 30, and 27% at 40.
So it looks like the group primarily in the 30% camp and very close. Our data set has indicated refi volume has dropped off about 25% month over month. And then lastly, we have one more after this, cash out refinance. Big topic over the past, especially the past year, as equity has continued to grow. How much did cash out refinance volume grow over the past year? 35, 45, or 50%?
Give everybody just another couple seconds to get their answers in. I feel like I should be going do 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 do. Oh, done. Okay.
Love it.
Okay, looks like we've got 44% came in at 35%, 22% came in at 45%, and 33% came in at 50%. So we're kind of split.
Kind of split. It absolutely did grow, which wouldn't surprise any of us. And our data that you can see here on the next page, this gives a month over month view, but cash out refinance volume grew almost 50% year over year. So substantial growth. We actually saw it grow month over month here in January. Obviously, it'll be interesting to see how that trends out and how potentially the home equity play comes back into the marketplace if interest rates continue to rise on the first mortgage side of the house. Last question here. So rates have been going up. Volume's been dropping on the refinance side, likely putting pressure on margins. What's everybody's best guess in terms of how much margins have compressed here over the past month or so?
Got some answers coming in. Give everyone just another couple seconds to get their answers in. Okay. Looks like we've got 6% came in at compressed. What's that? What are you talking about? 6%.
We need to go work there, Rich.
Well, I appreciate the honesty. I appreciate the honesty.
6% at 10 bips, 50% at 25, and 39% at 50.
Yeah, so in that 25 to 50 basis point camp, the majority of the group, which is kind of what I figured most of us would guess here. And if we look at what we're seeing based on a view that we often look at, and I'm sure many of you do as well, if you look at primary, secondary spreads, and this is basically a measurement of primary rates at the street consumer level, price combination versus what's happening on the secondary market. We've seen those spreads come in from a high of 150 basis points back in early 2021, as many of us were managing capacity, backing off margin, and trying to provide a good customer experience to our borrower member base. We've seen that come all the way down to, call it 110, 120 basis points. And just over the past couple months, with January being a volatile month on the 10-year and rate side, we've seen those margins compress about 25 basis points. With that, the environment has clearly changed from what many of us were facing over the past couple of years with the influx of volume and really, backing off price to manage that capacity side of the house, if you will. But regardless of the environment, this is what I commonly faced, and I know Rich did as well when we were sitting in the chair, and what we often hear from our clients in terms of common challenges that they face when they think about pricing. Some of these challenges may weigh more heavily depending on the environment, no doubt, but really 3 or 4 come to mind right now. Number one, anecdotes. I'm sure most of you are feeling the love, I'll say, from the sales team right now in terms of feedback from the team. As I like to say, when I was in the chair and managing pricing for 6 or so years, I don't think I received one phone call that indicated our pricing was too good. Typically, our pricing was challenged, we're out of the market, you're costing me loans, et cetera, et cetera. The beauty of the Kyranos solutions and having a framework around your pricing and margin management is having the ability to provide transparency to the team and building that trust and culture that you can provide transparency relative to your respective pricing strategy, whatever that may be. Maybe it's at market, top quartile, et cetera. And this allows you to put data to that transparency. On the top hand of the right hand side of the page, this is probably the most challenging question I always felt I faced in terms of running pricing. And that was, hey, John, you made a pricing move. Did it work, quote unquote? Well, that answer, as I think we can all agree, isn't crystal clear. But the beauty of the Kyranos solutions is it at least allows you to put data and analytics in terms of answering and managing that question, and allows you to reflect on that pricing move in terms of, should I keep that pricing move in place? Should I back some off? Do I need to adjust, course correct, et cetera? And then lastly, on the page here, I'll touch on one more, is the risk profile. I know many of the individuals on this call today are not necessarily probably maybe putting a lot of production on the balance sheet. Some of you may be putting production on the balance sheet, but some of you may be selling production into a Ginnie Mae security directly and or potentially to an aggregator. And the unique data set allows you to have a timely read on your risk profile and reflect on, am I being adversely selected? Yes or no? How should I think about that? Do I need to dive into a potential product or credit attribute? Look at my pricing adjusters, et cetera. So the whole timely read on a risk profile, I always found extremely valuable. And you can see some of the other ones, including the one on the bottom right, which was top of mind over the past year or so, balancing that operational capacity. So with that, I'm going to turn it over to Rich here. And again, feel free to ask questions in the chat, and or I've outlined Rich and I's email here on the page. Feel free to follow up via email either during or after the call, and we're happy to connect as appropriate. So with that, Rich, you want to take it away?
Absolutely. Thanks, John. So yeah, so it's really just kind of a segue to, developing a margin management framework, right? So for a lot of you on the call, you're really ultimately trying to achieve a proactive framework, stuff that John successfully, I'm sure, implemented at Wells, what I've successfully implemented at some independents and some regional banks. But really, what is the framework? Like, what do I need to be doing? How do I need to be assessing market opportunities and managing margin? We think it's probably the number one theme to this year of 2022. We all know it's a transition year. John talked about earlier, kind of the headwinds for the mortgage market. We've come off 2021, which was, I think, 4.8 trillion they estimated in origination. So record production, record profitability, and now we're transitioning into a more than likely, or it at least appears to how the year started, a rising rate environment. So we think margin management, that discipline is going to be probably one of the key themes and probably most critical components for those that ultimately thrive in this sort of new market. So within that sort of framework context, today we'll talk about kind of the different pillars, defining competitors. That's always one you think in a lot of cases would be obvious, but who do you really consider your competitors? And the profiles of those competitors John alluded to. Are they credit unions? Are they independents? Are they large independents? Are they big banks? Are they regional banks? The profiles could differ. And really, when you think about margin management, the competitors could even differ from a regional perspective. So where are you talking, or maybe a product perspective? Are you talking jumbo production? Are you talking conforming or government, right? It's got to be dynamic as you kind of define that competitor universe. We'll also talk about a true pricing strategy. You may not have one sort of overarching strategy for your entire footprint, but what are the various strategies you are employing today? Is it, and John and I can kind of laugh at this, is it simply sales kind of leads that discussion, right? They sort of assess the strategy. Hey, here's what we need to be. We'll talk about kind of developing something that's cohesive, and then we think scalable. Managing margins, we talk about kind of this dynamic nature in that third pillar. How do you price? It can't just all be through corporate margin. How do you think about your margin across products, across the different loan attributes, things like LTV and FICO or loan size, how you price your purchase loans, say, versus your refinance loans. So kind of a lens into that as a part of this sort of margin management framework. And then the end, ultimately validating the value you bring to your customers or borrowers, right? That being, obviously measure this from a share, market share perspective and what we capture in our originations benchmarking, but validating that value, right, for your customers. And certainly if you're from a servicing perspective, what you might have from a servicing portfolio. Next slide, Jeff. So kind of defining competitors, that first pillar we're talking about, how do you think about competitors and how does it influence your framework? I talked about the institution type or profile. As I mentioned in my experience, I worked at independents, and I too often heard, well, we only compete against IMBs. You may think that to be the case, but who's ultimately taking market share from you, right? And that's what our tools allow you to do through both a pricing lens and an originations benchmarking lens. Who am I losing out to? And maybe I do just want to focus on just IMBs, but it's important to kind of have a holistic view to the entire market. Maybe there are some credit unions that are becoming more competitive that might not be your primary set of competitors, but important to understand and sort of where that cost to originate might lie if you maybe want to look to refine your competitor set or refine your pricing position. Second bullet, we talked for, specific to retail, you've got your decentralized branch model, and then you've also got your consumer direct, or what we like to call your centralized model. Different assumptions perhaps there, right? Do you want to differ pricing across those two, what we refer to as kind of sub-channels on the Kyranos side? We see that as an active sort of strategy today. So think about that as you position your margin management and your price strategy. Purchase and refi, I think that's a huge one for this year. As refinance wanes and there's a shift to purchase, how competitive should you be on purchase? How much are competitors paying up for purchase transactions, right? You'll have that level of granularity and ability to see that. We're starting to see that being more dynamic, right? That's not a, hey, we're going to set it for a quarter and revisit. I think lenders are looking really on a weekly basis. As John mentioned, the timely aspect of our data, they're really trying to assess that opportunity. Hey, how much are purchase markets growing? Where are the fastest purchase markets in our footprint, right? And aligning your strategy with those market opportunities. And then lastly, if for those that do have a loan portfolio or balance sheet, how could that margin management or strategy differentiate between your held for sale versus your held for investment or portfolio loans? Next slide, John. So we talked kind of about defining competitors. Next step really in the margin management framework is defining strategy. And again, it doesn't have to be one centralized strategy. We talk to clients, I know from our own personal experience, right? It may be a different strategy by product. It may be a different strategy by market. But sort of how we define it on the left-hand side, is it a quartile or percentile? We have clients that often come to us and say, well, we don't really have a strategy. We can help define that. So Is it you want to be at the median of the market or the market average? Do you want to be maybe a price leader and you want to look at, okay, I want to be within the first quartile, right, of lenders and how they price? That may not be your target, but what's valuable within our data is you can see what it would cost. What's that spread if we did want to look? So I've had it where we were a second quartile and we want to see sort of what's that volume or share trade-off if we do lean into margin a bit and we move up into, say, that first quartile. It gives you that ability to index, right, where those different strategies might lie, and then ultimately that cost to originate. Competitor average is a common one. It's not one competitor rich. I mean, John and I hear this all the time. It's 5 or 6 competitors. It's 10 competitors. We want to look at kind of each of them, but we want to sort of establish an index or a benchmark. So let's look at all 10 competitors together. Let's think about that as an index or benchmark and see how we ebb and flow against that. That kind of helps normalize that day-to-day movement in price, right? So as lenders are moving in or out of market and adjusting price, which again, we expect to see on more of a daily basis or weekly basis this year, fighting for that, decreased volume. It gives you that ability to see that and understand it. And again, that competitor set can be unique to certain markets, unique to certain products. And then lastly, competitor profile kind of ties back into that a bit, but that institution profile, is it the large banks? Is it the IMBs? Is it the smaller IMBs or the smaller banks? And give you ability to see the whole universe. We've got markets we survey with hundreds, well in excess of 100 lenders. You can see the whole landscape, but do you really want to hone in on a subset of that landscape and really attach your strategy to that particular competitor profile? And then to the right is we think maybe specializing a bit or to that level of granularity that we survey and we capture within our data sets. You can't just give up corporate margin on everything. So do you want to be more strategic? Can we maybe layer in margin from some of this loan attribute conversation that John was talking about, things like LTV and credit score? So, think of your traditional LPA grids and how you price. Things like loan size. We capture pricing analytics from $50,000 loan amounts all the way in excess of 2 million, right? And we see lenders deviating price by those different loan sizes. Is there a potential strategy to employ there? Do you make that a practice today, or are you looking to differentiate? You'll get a sense for that distribution of the market. What's the average pay up for a $250,000 loan versus a $175,000 loan, right? And you can start to sort of optimize that position. Loan purpose, we sort of already touched on, but just that purchase versus refinance. Do you price the same across both purchase and refinance? Do you price differently? Do you feel like you're more competitive on purchase and less competitive on refinance, or maybe vice versa? Give you that ability to hone in on loan purpose. You can look at your mix relative to market. Everybody would love to achieve being a purchase-centric business, but the reality is not everybody is. So what's the composition of the market? Where can you go after, maybe lean into more of that purchase volume? And again, able to see that at a level of granularity by market or by product to assess those opportunities, right? The idea is get more specific from an attribute perspective. We're not having to give up margin necessarily broadly at top of house. And so you could get really refined with your approach there. Geography plays into it. I'm sure John developed as well a true regional pricing framework. If we've got 16 markets we lend in, should we have 16 different rate sheets, or should we perhaps differentiate maybe on kind of a more super regional basis? Maybe for 16 markets, we have 4 different rate sheets. Kind of done both. I mean, I've gone as from one institution I was at, we went from 3 pricing regions to about 24 pricing regions. And we use that as kind of a recruitment tactic, right? Hey, we go into a relatively new market. Hey, we can devise a true localized price strategy at kind of an MSA or CBSA level. So really helpful to think about it if you can establish that regional pricing component. And then the sub-channel piece we already talked about, consumer direct versus that distributed. Again, just different levers. It's not just one lever you're able to pull within your margin management discipline. You've got various levers to pull. And what you'll see within our data set and our client base, it's not just one lever that's being pulled. It's a combination of those levers. And I think ultimately finding out what's most effective. What that John alluded to, that price versus volume trade-off. Where do you find the biggest kind of bang for your buck or pickup? Is it at a loan attribute level? Is it changing something from a percentile or price position perspective, or maybe potentially kind of widening your scope of that competitor profile? Maybe there's somebody out there in a marketplace that isn't really kind of top of mind or focus for you, that really seems to be sort of a price leader or starting to corner the market and gain some market share. So as we talk kind of further, that those are the kind of the different strategies we think of conceptually. Other, I think, areas to just a general framework for margin management, policy considerations. So one thing we capture that I think is incredibly unique to Kyranos is price concession or price exception data. We know with retail lending, there's that level of discretion that you give to your regional kind of branch network, or maybe at a loan officer level, right? Helping track that as part of your strategy. And that goes back to something John mentioned at the beginning, which is transparency. If you're moving price and there isn't transparency from a field perspective or a production or sales perspective, they're not going to know. They might say, oh, wow, we got more competitive in price, but it's really that transparency that I think drives an effective framework, and understanding on how you're looking at your competitive position, who you're assessing to be your competitors, looking at the outcomes in terms of that origination data. How much share am I gaining? How much share am I losing? But it's going to give you, I think, that complete picture that you need. So you can see your rate sheet price or your go-to-market strategy. You could see a level of discretion in terms of this price concession behavior. And then ultimately, what did that materialize in terms of volume? Which again, as John said, is always the hard question. Was it successful or was it not? And sort of learning from those practices or behaviors. And I think some too in all this, just a regulatory or fair lending sort of prism to look through, right? I think you can definitely extract potentially some anecdotal information there around any sort of fair lending concern within that margin management or that price strategy. You'll hear me the second, I say it all the time, that it's proactive that wins, right? Being truly proactive in your approach versus reactive. I always felt before I sort of leveraged any of our solutions, at least from a price strategy, it was largely sales driven, and I felt like I was playing whack-a-mole, where one week it's this lender that's most competitive, next week it's this lender, and you're just constantly chasing your tail to understand, okay, where do we even need to be positioned? You didn't have a cohesive strategy. It wasn't proactive in where you're really looking at those market responses and market moves to understand, hey, how can we go into a few days, a week, even a month, and be more proactive in our approach and maybe get ahead of those market opportunities as the market gets volatile, right? Understand you get more or less competitive as far as your price position. And so that visibility, like we talked about, that transparency, daily pricing, real time in the originations, kind of combining those two data sets really gives you that ability to be proactive. And I think if you can do that in a way that sort of permeates through your entire company, you're just going to inherently kind of garner that trust of the group. So you've got your production, your risk folks, your credit folks, everybody understanding there's a proactive nature. We're not just reacting to what we see. Market share price trade-off, again, these are kind of getting into some more of the benefits. It's pricing elasticity and optimization, right? How much to know to move price and how much you can anticipate or expect from a market share or volume perspective. That's the $1 million question we're all trying to answer. And as John alluded to earlier, it's not necessarily always the easiest one to answer, but that's what everyone wants to know. And how can you optimize that trade-off? One thing we touched on earlier on the operational capacity or the challenges is balancing price with that. We capture turn times, so manufacturing times from taking a lock versus that loan funding. How do you measure against the industry? Do you have excess capacity? That's something you're able to see within our data set. Everyone would love fuller pipelines, but what can we ultimately deliver on from an operational or fulfillment perspective? Can you incrementally measure that, right? So as you get more information around that and kind of that incremental improvement or worsening the market, hey, we may be less competitive. Can we respond? Can we afford that additional pipeline from a capacity perspective? Fees we put on here, something kind of new, but I think certainly a pillar for margin management. When we talk fees, we're really talking Section A from a loan estimate or closing disclosure. What are your underwriting, your processing, your admin fees that you charge today? We've started collecting market data around that. Maybe not a lever lenders, I think, traditionally look at, or at least on a more regular cadence evaluate. Maybe there's revenue opportunity for us there. Let's look at the competitive landscape and understand, hey, maybe that's a potential area we could revisit. Is it competitive with market? Are we charging enough? Are we not charging enough? Those types of insights. So I think that can be something as lenders think about this year, and I can only take so much from margin. Maybe let's reassess our overall fee competitiveness. And then the monitoring piece, right? So there's a lot of architecture that, as we talk about establishing this framework, the plumbing and stuff that needs to be in place. But once you get that framework established, it becomes a monitoring exercise, right? Monitor against your defined strategy. And again, it can be one strategy, it could be multiple strategies, maybe that deviate by by market and geography, by those loan attributes we talked about, by your different loan products or different competitors, right? This is giving you that framework to monitor, so you're not running around sort of chasing all the intelligence. You've got a framework from which you can look at day to day, week to week, and assess and say, okay, this strategy is successful, or maybe we need to look to refine it, or maybe we even need to develop it. Maybe we don't have a strategy. It's a little convoluted. It sort of changes, right, week to week or month to month. Again, going back to that concept of different price leaders as I look at different products, look at different markets. So really the benefits, as we talk about this, obviously it's not something you can just turn on overnight, in establishing a margin management discipline, but what does it really mean from a true tangible benefits perspective? So profitability, and looking at the left-hand side, you limit that leakage through actual controls, right? You've got a true framework from which to manage price and manage margin. And through those controls, you can limit that revenue leakage. I talked again, those different levers to revenue and profitability doesn't just need to be a broad sweeping change. You can look to be very targeted in how you're moving your price and how you're employing those different levers. The industry margin changes versus market movements, that's a huge piece. As we see, and we've seen it this year, as we've seen volatility kind of creep back into the financial markets, there are certainly those present market opportunities. Not every lender is just pricing through. If you have a quarter in rate move one day, let's say, it's maybe a big economic report or something from the Fed changing their tone or stance from a policy perspective. The market moves. Everybody may not move the same amount, right? Or that magnitude or severity. There might be an opportunity there, whether you want to get more aggressive or you want to get less aggressive. And I think over time, you can kind of behaviorally see that there are certain lenders that we see in analyzing our data that become more competitive and when interest rates are rallying, or become less competitive when interest rates are increasing. So it gives you opportunity there to be nimble, to take advantage of sometimes those temporary market environments or market opportunities. Manage the financial goals and within financial constraints, right? You're really standardizing your framework here. So you limit the leakage. I think a big thing this year is just going to be margin preservation, not necessarily increasing gain on sale or overall margin, particularly with 2020 and 2021. I think that's probably almost next to impossible. But how do I preserve margin? How do I keep margin elevated for an extended period of time? Having this margin management framework and discipline will help manage to that. And then the protect against or take advantage kind of ties in a little bit to that second bullet point. Again, just being nimble enough within this framework to still take advantage of those opportunities. I think you're going to have more opportunities, this year we expect than prior years, and then kind of this new cycle as we transition. How can you be really proactive in that and seize those opportunities? So from an execution, again, optimization side, our data isn't just centric to revenue management teams or cap markets folks. I know John can attest, it's partnership from really an enterprise level. So working with your marketing team for pricing promotions or marketing campaigns. How can you better utilize our data to help support those or really measure those promotions, right? Getting back to what's effective, what's worked, and sort of building upon that. Establish and implement pricing strategy and policy. Again, having a true policy, like standardizing what you do, understanding what's the cohesive strategy or price position that you want to achieve, and you've got those controls in place that, again, can modify over time, but give you that baseline, barring anything else. Maintain or test a price position. That's the $1 million question, right? What's that sensitivity to price and that trade-off in volume? You can start to analyze that, and it may just be simply understanding and gaining that knowledge versus it being a true successful price test. I needed a 20% pickup in volume for a particular price test. I got 18 or I got 10. John and I in our experience wouldn't necessarily look at that as a failed price test. Hey, here's what we were able to help understand. We became more competitive or less competitive relative to certain competitors in the marketplace. We found that this market operated differently than this market. You start to combine your price position and price tests in different markets, right? You're going to see you get kind of more what's the bang for your buck in certain markets versus others. You've got consumers that are maybe more educated relative to other markets, right? Whatever that is, that consumer behavior, you can start to analyze that across different markets and ultimately test those outcomes. Smoothing the impact just goes back to that transparency. I think to be effective, you've got to have some level of transparency. If it's not across the entire organization, it's at least enough of the key stakeholders. So what are we looking at to analyze our pricing position? who's ultimately the decision maker, and what's the decision making process, and who are the key decision makers, and how do they understand this framework and understand sort of this solution set to help drive that. But I think that's one of the critical pieces, is if you don't have the transparency, I certainly don't think you're going to have the effectiveness. You're going to have one group doing one thing, one group doing another, and in some ways maybe supportive of one another or complementary, in other areas potentially counteracting one another. And then capacity and workflow management, we talked about a little bit earlier, that operational excellence. How can you really better manage your workflows to understand how quickly competitors are manufacturing and closing loans? Do you want to go after more volume? How does that impact your overall capacity? And you'll have benchmarking around that can give you that ability to either celebrate those successes. We have clients often say, well, I had no idea we were a top five. We were top five in terms of turn times in our core markets, right? That's valuable insight, and really been a key motivator in my experience for fulfillment teams, having a true measurement, a true benchmark to say, oh, we did 500 loans this month and 400 last month. Great job, team. No, we've really improved our rank in our certain markets and at our various kind of fulfillment locations.
Hey, Rich, we had a question that came in. Do you take into account any changes in LO compensation relative to margin pricing movements?
Yeah, so we get the question often. How we sort of factor that in is when we work with lenders, and again, from a pricing subscription basis, it is by market. So we've got roughly 84 pricing regions for the retail space that we survey. We will ask lenders, what is the dominant LO comp in terms of where your volume's attached? And so typically, overwhelmingly for most clients, they say this is the LO comp that most of our production is originated based on. And then we factor that into our pricing intelligence.
Tony, you there? Any other questions coming in?
No other questions. Can you hear me now?
Yep. Sorry,
Sorry,
you
my
looked
internet
frozen
is
there for a while.
my internet is a little bit shaky right now. Well, I did have one other question, or actually two. So, you guys were customers of Kyranos in your prior lives. So, what are one or two ways that you utilized the solutions that were offered to you?
Yeah, I can take that one, Rich. I mean, we used it in multiple ways, but if I had to really boil it down and to call it two or three main ways, number one, and Rich kind of alluded to it, as I think about pricing, you really got to have discipline, as I say, around managing pricing and margins. How often, when are you looking at competitive pricing? How often and when are you changing pricing? Who is making that decision? Who has influence on that decision? Who else is involved in that decision? What does that pricing policy look like, both for internal purposes and, Rich alluded to it, for regulatory purposes? So you've really got to take a step back and think about, what is my pricing strategy and what does the discipline look like in order to manage that pricing strategy effectively? Once you have that down, we've really leveraged, in my experience, I've really leveraged the data in a few key ways. Number one was just really trying to understand that price volume trade-off. And what I mean by that is, without a data set like this, one might make a pricing move and you can see your volume internally and see, wow, our volume's up 10, 15%. Wow, we're killing it. Well, what if I were to tell you the market on that exact product in that geography, maybe that you juiced price, was up 25%? It may cause you to think differently about that respective pricing move. Secondly, I would say, and I like how Rich used the term whack-a-mole. I think a lot of us can relate to that. I mean, sales feedback is an important part of the process, but that's one part of the process or pillar within the pricing strategy and framework. Really having data and facts to help guide that discipline and framework, I think, is critical. And this data allows lenders to provide transparency both to the leadership team and the sales force, which I think is just really important to build that trust with the sales force that, hey, we're in this together. I want this loan as much as you do, but we have an obligation as well as a team to do what's right for the firm and the organization. And then thirdly, I would say the ability to identify market opportunities, especially in a tight market like this. Where are the opportunities? Where is my share under indexed? What does that look like by potentially product or geography, what have you? So those are probably the top three that come to mind when I think about that question, Tony.
That's great. Thank you so much. And then kind of a follow-up to the last question is, what are you hearing now from your clients?
Rich, you want to hit that guy?
I can take that one, certainly. I think it's overwhelmingly margin compression and pricing pressures, right? And I hopefully was realistic in kind of what we conveyed. This isn't an overnight process, right? If you don't have a disciplined margin management team or practice, it isn't something you can just stand up overnight. Like you need a true, as John kind of mentioned, like a true single source of record. I agree. Field intel's fantastic, and I always empowered the sales force and production leadership. Send me all the loan estimates you can, and I would get probably a dozen a day. But that's going to give me a window into this much of my production, right? Like we talked about our pricing assets, 4 billion rep lines. So a loan estimate that's at a 3.5% interest rate shows I'm out, 100 basis points in rate. Yeah, well, what does it look like at a 3.25? Like you got to start thinking holistically, right? How you manage the business. And I think too often you get down in the weeds of just those one scenarios or, hey, I saw 12 loan estimates today and 5 of them were this lender. Well, they must be my primary competitor. It's just totally random selections. So I think it's standardizing the framework. And as we work with clients, it should give you that relief and benefit of I've got something objective that I can scale. And so it's really just supporting that, hey, we don't really have a defined price strategy. We know our margins are down. We look at our fourth quarter results or our first quarter results. We know what the public or institutions are posting. It's a common theme. How do we better position ourselves? And so it's starting with kind of this conversation today around, well, what's your margin management framework today? And John will attest, it can be a little disjointed, sometimes a little chaotic. It might be pretty siloed as well, where you don't have the key stakeholders all talking to one another. So everyone's kind of got their set objective or strategy that they're trying to accomplish. I mean, at the end of the day, everyone wants to maximize revenue and maximize volume, but how do you do it? And so we try to help educate of, okay, you want to remain competitive. What are the different levers you can pull today? Because those mechanics are key. Not every lender has the ability to price at a loan attribute level today. So, what's your pricing process today? Walk us through those steps. So that's where the architecture becomes critical. But, I won't mislead it. It does take time to establish that discipline and to really develop the knowledge of how sensitive are your consumers, how sensitive are your markets. And you're not going to know that ultimately until you start doing some price testing. You can always say the hypothetical what if, but you really got to start conducting those tests to really have those measured outcomes that hopefully, although not always the case, tell you something a little bit more behaviorally about what's going on and where you need to be from a pricing perspective.
Yeah, I like how you mentioned levers there, Rich, really understanding not only your levers that the organization can, I'll say, implement internally, whether that be geographically, loan size, FICO, LTV, what have you, from an engine perspective, if you will, but also just understand what are your, I'll say, holistic revenue levers. And Rich touched on one earlier. That's one that I've heard a lot lately from my clients, Rich, and that is one of the revenue levers that I think often gets overlooked is the whole Section 8 kind of what I call flat fee, processing fee, what have you. A lot of us use different acronyms or terms for that admin fee, if you will. But it's not a major revenue driver, don't get me wrong, for probably most of you on the phone here, but it is a lever that nonetheless I would be thinking about evaluating on some sort of regular cadence, whether that's quarterly, 6-month, annually. I can't answer that for you, but in my conversations with some clients, especially of late, when clients are really trying to just manage margins as tightly as possible right now, given volume is down. That is one lever at their disposal. And oftentimes when I bring it up, the response is something to the effect of, oh, you know what? We haven't really looked at that in 2 years. Well, totally understand. It's been in different environment, but that's all the more reason why now is probably a great time to be diving into one of the levers at your disposal.
Excellent. Well, thank you guys so very much. To everyone who joined us today, thank you so much for coming to TMC Connect. We hope that you have are able to take away something. We know that the information that we've had provided here is great quality stuff, so we appreciate it. The information, if you want to follow up with Rich or John, please feel free to do that as well. And please come back to TMC Connect anytime, because we have got some other great sessions for you. So thank you so very much, and hope everyone has a great rest of your week.
Thanks, Tony.
Thanks, guys.
Thanks, Tony.
Appreciate it.
Thanks all.
Take
Bye.
care.